Welcome back, everybody. Today we're going to do an analysis of AutoNation. Now, the reason why this stock actually came to my attention is because I heard that they're doing massive amounts of buybacks, and yes, they have. So they have returned 312% over the past 5 years. Absolutely stellar performance. And this is what their chart looks like. Very steady up and to the right. Um, can we expect that going into the future? Well, probably not, and we'll see why. Taking a look at their all-time chart also, this is kind of a concerning chart. I don't really like charts like this. It's like very boom bust, very cyclical. And you can see that they've only returned 1,300% since 1980. So not very good return on the all-time chart. And you can see how cyclical this business is. And right now they are at an all-time high. It could be close to a peak for them. So they are a $6.4 billion company, and their price to earnings ratio is only 7. So actually very low price to earnings ratio. So that is really, really good to see. There might be some good value left in this business. Now let's take a closer look at their financials. Yeah, and if you don't know what AutoNation is, they're basically like a dealership, but they also sell lots of other things, parts and whatnot, and they do repairs. So there's a few different parts to their business. But let's check out the numbers here. Their revenue has been pretty steady, and then it increased right into 2021, and it's probably going to stay very steady moving forward. In terms of their gross profit pretty much translates with the revenue, and operating income translates pretty well. Pre-tax income, yeah. Their profit margins stay pretty steady for the most part. They're very, very slim margins as well, so note that. And take a look at their shares outstanding. They went from almost 100 million shares down to 44 million shares. So they do tons and tons of buybacks. And usually that's one way to return capital to shareholders, basically. In terms of their balance sheet, they do have quite a bit of debt at 4.6 billion. So maybe they should have been paying off debt rather than repurchasing stock. Just a thought. Probably not the best management decision in the world. Also, something I wanted to note about this is their current assets have been increasing a lot since 2021, from 2.8 billion up to 4.3, and that is because of inventory. Their inventory has been increasing a lot. That basically means that they've got a lot of cars on the lot that they need to sell, and if they need to sell a lot of cars, they'll probably end up decreasing prices, and that won't be good for their margins. So their margins could probably take a hit. They might even go negative. In terms of their cash flow, they actually had negative cash flow last year because they had so much in capital expenditures. So yeah, and they also bought back a lot of stock. So they bought back a bunch of stock, and they had negative free cash flow. So they had to take out a bunch of debt in order to fund their operations. Not exactly what you'd like to see. But the reason why their income is still positive and positive by a lot is because they count inventory as towards their income, even though the cars haven't sold yet. Taking a look at the stats, let's take a look at their margins really quick. Their net margin, it hovers around 2%, and then it jumped up to 5% when they were selling a lot of cars, and now it's going back down to 3%. Probably they'll go back down to 2% at some point pretty soon. They might even go down to 1 or even 0 for a little while, but I would expect them to hover around 2 or 3% for the most part. Let's look at. Okay, so this is an investor presentation. I looked through the whole thing. There's not really a lot of interesting information, and they don't even talk about how much inventory they have. So I really don't like how companies, they always paint a super rosy picture in their investor slides, and there's not even that much interesting information here. The only thing I could find is they're not making as much money on their new vehicles. They're basically making $3,600 per new vehicle sold on their platform or in their dealerships, and so that's down from where it was last year. And they're making less money on their used vehicles as well. So yeah, like I said, their margins are are getting squeezed here. Let's take a look at the analysts, what the analysts are projecting here. And the analysts are projecting quite substantial growth into next year and into 2025 in their earnings per share. And their revenue is going to stay pretty steady at like 27, 28 billion. Taking a look at their stats, let's take a look at their short percentage. And their short percentage is 11%, which is actually really high. So that is a big red flag with this business. So that might be a reason why you would not want to buy. Although people going shorter business could possibly be wrong. So don't rule that out. Let's take a look at the DCF model here that I have. Now this is what I put. I put the analyst estimates for these, and I am estimating 600 million in buybacks for next year. Discount rate of 10% because I want the 10% return. Exit multiple of 15. Right now they're trading at 7. So that might be a little bit high of an exit multiple, but also it's still pretty low. So I feel like 15 is fair. In terms of their earnings growth, well, they're projecting 6%. So I put 6% there and then 2% from that. And in this case, the fair value is going to be like $243 per share. But if you account for the debt, then it's down to 132. So normally I would project the fair share price to be in between these two numbers. Usually debts are not all that scary. And as long as you're making service payments, then debt's not really a big deal. So I would put the fair share price probably around 200 if this case plays out. But I do kind of expect their earnings to be negative, probably for a few years, just because I mean their earnings growth to be negative, maybe not negative earnings in total, just because their margins are getting squeezed. And we can project this better probably with the revenue margins model. Now they did 3% last year. I think they're going to go down to 2%. And I think historically they've been around 2%. So I think 2% is probably pretty fair. And revenue growth just keeping up with inflation at 3%. And in this case, we can see their fair share price being at 188. And after they pay off debts, then it would be 78. So probably I put their fair share price around where it is at like 150. But definitely their margins could get squeezed down to 1% or even 0 for a couple of years. And if that case plays out, just because they've got such big inventory, like maybe next year they go down to 1% profit margin. Then after that, maybe they go down to 0. And then they have to climb back out and they go to 1. Maybe this case plays out. Yeah, which I think is definitely possible. Then their fair share price is probably more around like 110, 120. Yeah, I wouldn't put a lot of eggs in this basket just because it is heavily shorted. But they do a lot of share buybacks, and you could see pretty decent returns in the stock just because they're making so much money right now in terms of their earnings, not in terms of their cash flow. But yeah, that's what I think about the stock. And let me know what you guys think in the comments. Feel free to debate me. And yeah, hit that like button. I'll see you in the next video.